I'm Jessica Peresta, host of the Elementary Music Teacher Podcast, a part of the Education Podcast Network. Shows on the network are individually owned and opinions expressed may not reflect others. Find other interesting education podcasts at edupodcastnetwork.com.
Hey, welcome back. Steve here, and today I'm talking with Dr. Michael Grayson about spending, outside influences on spending, and credit scores. You know, they're so important, and you really need to understand them. That's really cool. Awesome conversation. So much to learn. By the way, also at the very end, you got to make sure you listen for a very special offer from Dr. Grayson. Thanks for listening. Oh, by the way, before you go, there's a couple ways you can help out the podcast, and here they are. How about tell a friend and share links, or how about go to my website and leave a review and subscribe, or how about click on the link on my website homepage where it says Buy Me a Coffee. And by doing this, you could donate $1 or $2 or $5 or more to help me address the costs, associated with producing the podcast. That'd be so cool. You are awesome. Enjoy the show.
Well, it becomes a vicious spiral, because, even at, if you're paying a minimum payment on $10,000, it actually takes you 29 years to pay that credit card off.
It's the Education Podcast, your favorite show, with lots of groovy guests and they share what they know. So crank it up to 10 and let your neighbors know that here's another show with Dr. Steve Milletto. Teaching, learning, leading, K-12. Teaching, learning, leading, K-12. Teaching, learning, leading, K-12. With Dr. Steve Milletto.
Dr. Michael Grayson is a credit expert and advocate with extensive experience in credit repair and financial literacy. He has dedicated his career to helping people and businesses navigate complexities of the credit system. Dr. Grayson is known for his tireless advocacy for consumer rights and his efforts to expose and rectify injustices within the credit reporting industry. So here's a little bit about what we're going to go into. Wallets are tightening up again. A new report has revealed that consumers are looking to spend less on away-from-home entertainment and vacations in an effort to save up for the remainder of the year. This comes from the 2024 KPMG Consumer Pulse survey that was recently conducted, which notes that Americans will likely reduce monthly spending in various areas, including dining out, down 9%, entertainment, down 8%, and travel and vacations, down 7%. It's a huge change from last year's spending around the same time, but there's a reason for it. Dulip Rodrigo, who serves as U.S. Consumer and Retail Sector Leader for KPMG, notes, consumers are tightening their belts another notch as they hunt for discounts, and even some essentials are being impacted. Why the change? Likely due to inflation, not to mention the fact that the Federal Reserve is in need for a much deeper cut, and the high pricing of items like gas and even certain food items certainly doesn't help. Could this trend continue? Joining us today is Dr. Michael Grayson, who is a renowned credit expert and advocate to discuss the matter. His knowledge in all things investment and planning for the future will help us in this discussion. Dr. Grayson, thanks so much for being on the show. Say hi to everyone.
Hey, it's a pleasure to be here.
Well, great to have you. And I got to ask you this first. What inspired you to focus on helping consumers with, financial planning, money management, planning for the future?
Well, I actually got into this field, I'm going to say kind of by accident. I'm an engineer and a mathematician, and I was working for DuPont at the time, and my contract was up. So I started shopping for another job. And at the time, I lived in a very restrictive community, and my car, I had a Mercedes, it needed a new exhaust. So the police were giving me a hard time. So I started looking for a job that actually gave me a car. And so at that time, the credit industry was looking for mathematicians. They were about to introduce the FICO credit scoring system. This was right around 2000. And, as an engineer at the time, I was only making about $45,000 a year. The credit industry paid me a lot more money, and I ended up staying in the credit industry.
All right. So before we go any further, we're going to talk about information that was highlighted in a KPMG survey. So why is this a source that we should pay attention to?
So KPMG is a subject matter expert. The average person won't know them or they'll never see them, but for industry people like myself, we rely on their data analytics.
Awesome. Okay, cool. So these results from KPMG, did they surprise you, or does it sound about right that Americans are trying to save money and not do lavish spending?
Well, KPMG is a very good source for information for industry professionals. Their data analytics are considered to be among the best in the industry. So if these guys are saying that is the way it is, that is definitely the way it is.
Very cool. So that makes a lot of sense. So, all right. So let's talk about some of this information then. How much of an effect does inflation and the economy as a whole have when it comes to consumer spending? I mean, is there if this happens, then that happens type thing?
Oh, that is an excellent question, and I'm glad you asked that, because everybody in the country right now is focusing on inflation. Inflation, yes, it is a factor. I went shopping myself the other day. I was just going for just something to eat for one night, and I couldn't believe that one bag of groceries cost me almost $70. I was like, wow. Because you hear inflation, and the cost of goods and services are increasing, but you don't really feel it until you feel it. But ultimately, inflation is out of our control. So, the government policy is to try to control inflation with interest rates. And the feds are saying that they're going to lower the interest rates in the next, 2 months. Right around September, they're planning to lower the interest rates. And we know with this being an election year, that is probably true. But ultimately, that is only one of a couple of factors that are really hitting you in the wallet and making you feel it even more. Inflation, because it's always in the news, it's easy to point to that. But realistically, there's some other factors that are even more important than inflation.
Awesome. So, all right. So let's, can we go that route for a minute? I mean, what are some of those factors?
Okay. So let me say probably number one factor that is impacting your wallet. So if you remember back right before COVID, the Pew Research Group did a study. And in that study, they said that the average American, 60% of the population, cannot put their hands on $500 in the event of an emergency. That was before COVID. So then you have the COVID situation where you're sheltering in place, people not working gainfully. So we had to come through that situation. So now Americans are still in a position where they don't have a lot of savings. So, a lot of people forget that COVID officially ended last year. So COVID had a major impact on our savings. Now, that's one thing. Now, the second thing is, and I think maybe the most important, is cost of credit. Cost of credit is out of control. If you look at it by the numbers, currently the average credit card interest rate is hovering right around 30%. It's 29 point something percent.
Wow.
Now, as a mathematician, that kind of scares me.
Yeah.
Because the lowest interest rate is 0. So what I didn't realize, and I had to go and check this myself, now the max interest rate is now been moved to 35.99. So there are a lot of credit card companies that are charging you, and you should check this, 35.99% interest. And I thought that was unusual because I hadn't checked in a while. I believe that usury in this country, I thought, was 32%. I said, hey, wait, how can they charge 35.99 when the maximum usury rate is 32% in this country? That is no longer the case. That hasn't been the case for a while. In fact, one of the things that's driving interest rates is Americans' prevalence for payday loans. So payday loans, 12 million Americans take out payday loans every year. Payday loans payments, the fee payments, are $9 billion annually. Now, in some states have had to adjust the interest rate to compensate for payday loans, which are exorbitant. In fact, and look at this seemed unbelievable to me, but in the state of Mississippi, the maximum usury rate is 305% interest. 305% interest.
Wow. Oh my gosh.
So the cost of credit is really getting out of control. The average American now, because they don't have savings, they're dumping money on their credit cards. I think they'll at last look, the average balance was a minimum of 10%. So 10%, and you're paying 30% on average. That is a huge bill every month. The other thing that's really beating Americans down, and you got to look at this, rents jumped 30.4% between 2019 and 2023. So the cost of housing is very expensive right now. So rents are through the roof. As you know, housing prices are very high. I had a client call me in panic mode the other day, something I didn't realize. There's a lot of tax foreclosures. So this client has a house that's worth $500,000 now, and so they reassessed his taxes, and the government wanted $50,000 from him, which he did not have. And so they initiated a foreclosure for his taxes. So Americans are getting hit, Steve, everywhere. I mean, they're just getting hit.
It is very rough because you can't afford groceries and a place to live.
Yes.
This is not, and then on top of that, if you have a family, it's not just you. Then you have it just builds to a really rough point there to try and figure out how to make it happen. I mean, I am in my family. I had someone who, now this is a bunch of years ago, but in the 90s, he got into the point of using a credit card to pay a credit card.
Yeah, a lot of people do that. Yes.
And what are they in danger of when they start doing stuff like that? I mean,
well, it becomes a vicious spiral, because even at if you're paying a minimum payment on $10,000, it actually takes you 29 years to pay that credit card off. If you were paying the minimum payment at an interest rate of around 30 on 10 grand, it would cost you're paying around $300 a month, and it would still take you 29 years to pay that card off. So if you're paying with other cards, your overall principal balances are growing out of control. There's one remedy that our company employs that I'd like to share with your audience. As you improve your credit score, you have to keep an eye on something. In America, when you sign up for a credit card, you sign what's called a restrictive endorsement. So a restrictive endorsement is a contract that exists that you might not know it exists. So that contract says that as your credit score goes down, your interest rate goes up. So you might start with a credit card at 0 or 3 or 4 or 5%. And now you're trying to figure out how did I get to, 30% interest? So credit card companies are constantly pulling your credit, which you've given them permission. And every time they see that your credit score goes down, they will raise your interest rate. Now, fortunately for us, back during the Obama administration, he passed a law that says as your score goes up, your rates have to come down. Unfortunately, it's not automatic. You have to monitor your own credit and then request a rate decrease from anyone that's providing you with credit terms. So for instance, it's called 0-point conversion. So your credit cards, as you exceed, 720, for instance, 720 is like a magic number to get tier 1 across the board. So if you're at 720, all of your credit cards should be at 0, but definitely at 3 to 5%. So you want to get on the phone, call your credit card companies and say, hey, my score is very good. Please lower my rate. Now, I'm going to give you some inside information on this. Now, most credit card companies will automatically, if you request it and your score is good, give you a lower rate, but they like to tier you down. So what that means is, like I had a client who was with American Express. They were charging him 22% interest. He made the phone call. They took him down to, I think, 15%. And they told him to make 6 months of payments, then he can call again. And so they put you on a 6-month cycle to bring you down. But you have to be very diligent and make sure you stick to that time schedule, because you need the lowest interest rate. Now, one trick that I try for all of our clients, and I use this trick personally, I have Capital One. And I've had Capital One for a long time. And I got Capital One at an introductory rate of 0. It's only 18-month program. So I call Capital One and say, hey, you go from 0 to 13%. That's, based on my other credit cards, that is cost prohibitive. Can you give me a better rate? They say, yeah, for you, Dr. Grayson, based on your credit, we can give you, 9%. And I said, well, 9% is still a little high for me. Get me to 3%. Right around 3 to 5%, I will stay with you. And he said, I'm sorry, I don't have the authority to do that. I said, no problem. I love you guys. I've had you a long time. Cancel my card immediately. Okay, so after canceling the card, now check this out. 2 weeks later, I got a 0% pre-approved card from Capital One. Nice. So sometimes, you have to have a strategy and stick to it. But whether you take their 6-month program or you try a more aggressive strategy, the goal is to lower your interest rates. And even with your insurances, please make sure you're calling your insurance for your car insurance. Most Americans don't realize that your car insurance is based on your credit. So it's credit, it's driving record, and it's zip code. So those are the 3 major factors, with credit score being one of the highest. So as you exceed 700, you should be calling your auto insurance and making sure you're on a tier 1 status. All of your insurances are based on credit, so make sure you're at tier 1. But the 0-point conversion will save you between 600, depending on the amount of debt you have, between $600 and $2,100 per month, every month.
Wow, that would add up fast. So let's talk just a little bit about credit scores, because yes. One of the things you can't watch TV without seeing advertisements for all kinds of things, people watching their numbers and all this sort of stuff. And I hit this magic number, and you even said that 700, 720 is like this magic area. Can you talk a little bit about how you impact it positively, and really what that credit score is all about? Because why you care, I guess, is my point. Why do you care about that credit score?
Okay. Oh, excellent. I love this. Okay, so let's start by understanding credit scores. So the first scoring number that you should aspire to is 680 credit score. In America, to do business with the government, you have to have a minimum 680 credit score. Why is that important? Well, for government jobs. So I did a class for the Department of Justice, because all of their employees, they do random credit checks. If you dip below 680, you have 90 days to restore your credit or you are terminated. So most government jobs now have some type of credit standard. So you can't get hired. You can't even join the military now if you have less than a 680 credit score. So 680 is called performing credit. If you are less than 680 in America, you have non-performing credit. And what that means is non-performing means that they're going to punish you for using your credit. So if you buy a car, you will be considered a secondary finance. So secondary finance is very high. It's not tied to the prime rate. It's tied to a profitability index. So the interest rates are very high. If you apply for a credit card, you will still get approved, but they're going to punish you with brutal interest rates, 35% interest rates. So that kind of thing. So the minimum goal, I advise all of our clients not to apply for anything under 680, not even jobs, not promotions, all of those things. Now, 60% of employers say that number one is your credit. So it's your credit, work experience, and educational background. But credit for a lot of them is number one. So you want to make sure that you have at least a 680, if you're in the market to get a promotion or a new job. So 680 is performing credit. The next marker is 720. Now at 720, you have access to capital. So 700 credit score is great. And a lot of people say, hey, I'm 700, but 700 does not necessarily get you access to capital. What that means is cash loans. Part of building your credit is to have installment loans, cash money. So once you're over 720, you can get cash money. Unfortunately, on all three bureaus, you have to be at 720. Anything less than that, you can still get stuff. Buy cars, houses, those kinds of things, but you're not going to be at what they would consider tier one. So 720 is the next marker. And then the last marker would be 800 credit score. At 800 credit score, technically in this country, you are a millionaire. You have access to $1 million. Right now, if you have an 800 credit score, I have an SBA loan product I could get you that will get you $1.5 million. So let's say you are working at McDonald's today, but you have an 800 credit score. Do you know that you could apply for an SBA loan, $1.5 million, and buy a McDonald's franchise? So that's what we teach. We have team credit classes that we teach, in our church and things of that nature. So we teach them that at 18, you should start building your credit. And after 5 years of doing anything, technically you are an expert. So 5 years in a job, now that you're an expert, you can apply for business loans to go into that field. So those are the three major points that you want to hit. Now, how do you build your credit? Well, you have to know this, that starting in the year 2000, we switched from the old credit system to the new FICO credit scoring system. And the major difference is in the old system, and a lot of times people are still thinking in terms of the old credit system. So in the old credit system, it was merit based. So if I say, hey, Steve, how's your credit? You could say, well, I pay my bills on time, therefore I have good credit, okay? But in the FICO system, that is not necessarily the case. In the FICO system after 2000, there are 5 parameters that control your credit score. And unless you have memorized these and know how you're performing in each category, you need to really review your credit score every month. And that's what we recommend for our clients. Look at your credit score every month because it's constantly going up and down. But there's 5 components, and you need to build positive traits in each of those 5 components. And that's how you maintain a very high credit score.
Awesome. So let's talk for a minute about the differences, because you mentioned something I want to kind of go with, which is you have an 18-year-old versus like a 40-year-old. When we're talking about building your credit or keeping it moving in the right direction, is there different advice you give them for the different ages, brackets that they're in?
Yes. So starting with for our teenagers, we have a minimum goal of 700 credit score. And realistically, that is very easy for them to obtain. So your checking account in America is your first piece of credit. So we make sure at 18, they have a checking account and then 2 credit cards. That's all it takes. If you have 2 credit cards and you keep low balances on them, you will be at 700 credit score. Now, as we review credit reports, so the older you get, the expectations for credit become radically different. So for instance, I looked at a client, they had very terrible credit. We went through, removed, all of their derogatory credits. It's called zero derogatory credit, which is what they want. The problem is they hardly paid any of their credit on time. So we had to remove 99% of their credit. So for this client, they're at 40 years of age, which is the peak time for their employment and career. You have 2 or 3 trade lines on your credit. So every credit entry is called a trade line. So banks and lending institutions are constantly looking at the number of trade lines. So at a certain age, in the prime working years, 21 and up, creditors are looking for a minimum of 10 trade lines. So 18 and 19, it's okay. You can have 2 or 3 trade lines, no problem. We don't really push our youth to have more than 2 or 3 trade lines until they work for 5 years. After you work for 5 years, you should have 10 trade lines. But as you get older, so say for instance, you're in your 50s and you're looking for credit and you don't have at least 20 trade activities, banks are very suspicious. So they think, well, you had horrible credit and you had somebody erase it, or you're not a friend to the system because you're not using it properly, or they think you're lying about your income. So on an application, you're asking for income, and so they have what's called a BICS, a banker's internal credit score, that's scoring you against certain parameters. It's an algorithm. So you have to think in terms of an algorithm. So you can't say, I'm a professional, I have a good white collar job, but you have 4 trade lines, and you say that you make $100,000 a year, no one's gonna believe it. The algorithm is gonna say fraud or some other flag. So the goal is to get pre-approved by the computer. So that's how we try to build everyone's credit. So, some applications say, hey, you'll get approved in 60 seconds. So you have to think like the bank. So the older you get, the higher your profession or your career status, your credit has to be built out in the same way. And another thing, like for instance, the once you're over 30 years of age, the algorithm is grading your trade activity. Let me give you an example. If you said that you make $100,000 a year, but your auto loan is $10,000, that is a red flag. For a 20-year-old, and I'm glad, no one's ever brought this point out. I'm glad you brought this out. For a 20-year-old, you can have a $5,000 or $10,000 car, no issues. If you're 30 or 40, depending on your employment status, a $10,000 or $20,000 car becomes a negative. They're looking at certain income levels. The algorithm is looking for certain types of cars. They're looking for, 30,000 plus. They believe that your trade activity will be commensurate with your income level because you're an American. So that is a very important consideration, because sometimes you have very good credit and you're still getting turned down, and that's because you're not thinking in terms of the algorithm. Excellent point.
Thanks so much for talking about that, because that's something that, I think a lot of times, it's kind of lost on people.
Yes.
It's because there are those differences. I mean, when you start off, and then, because obviously at any of those areas in between and beyond, you can make mistakes,
Yes,
or you can create problems for yourself. What's something that people don't understand the most about, what could just negatively impact that credit score?
Yeah. All right, so the biggest factor, so let's look at the 5 factors. So payment history is what everybody focuses on. That's all everybody care about is payment history, looking at their payment history. But payment history is only about 35% of your score. Your amounts owed or your utilization is 40%. It is actually bigger than your payment history. So yeah, paying on time is very important, but using your credit cards the right way is probably even more important. So I'm going to give all of your listeners a secret. We'll call it a parlor trick, so you can impress all your friends the next time you're talking. So depending on your score, you now know what your problem is. That's what I'm going to teach you right now. So if you're in the 500s, payment history is your issue. So you need to focus on payment history. You need to talk to someone who can fix your payment history. The goal for payment history is ZDC, which sounds unreasonable. It's zero derogatory credit, but that is what banks want. They want zero derogatory credit, not a single late payment. They don't want to see it. Zero. So you have to work with a company like ours that is skilled in getting you to ZDC. A big problem in the industry, right now, Lexington Law and creditrepair.com just got fined almost $4 billion for consumer fraud. Payment history, you want zero derogatory credit. Make sure you're using someone that gives you ZDC. But more importantly, if someone has a 600 credit score, then you know that they have a credit card problem. The algorithm, which I wrote the algorithm for credit restoration, the algorithm is looking for 2 credit cards. So anybody that you talk to, if they don't have at least 2 credit cards in their pocket, then you know that they have bad credit. And when I say bad credit, I mean less than 720. So you have to have at least 2 credit cards and the balances have to be low. So if you're in the 600s, there's some type of credit card issue. If you're in the 700s, you have a mix of credit issue. What that means is you don't have enough installment loan activity, and primarily probably a major installment activity like a mortgage or a car loan. So that is what you know. So 500, it's payment history. 600, it's credit card. 700, it's installment loan activity.
Gotcha. Appreciate you sharing that. I've got just 2 more questions left, but before I do that, I gotta ask you this. You've mentioned your company a couple of times. You founded this company. It's called CDMI. Can you just tell us a little bit about what services it provides and share something about it?
CDMI stands for Credit and Debt Management Institute. We've been in business since 2000. We currently hold all 3 credit industry records, including the highest credit score in the world. So we have all 3 credit industry records, and that's primarily because I wrote the algorithm for credit restoration. We work with traditionally a lot of high net worth individuals, but recently we set up a new program to introduce people to our technology. So we are not a credit repair company per se. Most credit repair places simply dispute stuff on your credit and hopes it falls off. That's not what we do. We use a science called debt filtration, which is much more effective, where we force the creditor to remove the item from your credit. It's radically different than credit repair. So to introduce that, we set up our website. It's called perfectcredit4free.com. So for all your listeners, Stephen, if their first 500 people where it says referral code, if they type in your name, or unless you want to use your call letters, we will fix their credit for free. We'll fix it for free for 500. We will guarantee a 50 to 100 point increase, 90 days or less, to show you the power of debt filtration. So just briefly, debt filtration is a government law or program that is designed to eliminate your debt and restore your credit simultaneously. So any problem that you think you have, if you do this simple Google test, like for instance, if you think you have a student loan program, Google student loan plus cancellation and forgiveness, and you will find the right programs to eliminate your debt very quickly and restore your credit. So if you defaulted on a student loan, you get in the right program. Not only will they lower your payments radically, and in the program after 20 years, it cancels the debt no matter what you owe. In the program, the lowest payment is $5 a month. So no matter what problem you think you have with student loans, there is none, because you can lower your payments to $5 a month. You pay that for 20 years, then the entire amount disappears. I had a client that owed $450,000 in student loans. They're paying $5 a month. So after 20 years, they paid what? They're paying $12,000. That is it. So in addition, if you're defaulted, again, after 12 payments on that program, it cleans your credit automatically. You don't have to lie to the credit bureaus and say, that's not my account. It cleans it. So that is a pure debt filter. Income taxes, you think you got a tax problem, you don't. Google income tax cancellation and forgiveness, and you'll see the offer and compromise product. So the IRS offers offer and compromise. It reduces your tax liability 90%, up to 90%. And then it gives you 2 years to pay the balance. Once you make 2 payments, it cleans your credit automatically. They'll remove it from your credit. So there's a bunch of those programs out there, and we can, if there's interest, we can talk about those on another show. But there's a bunch of debt filtration programs. We use all of them to affect positive change in your credit. And again, if you go to perfectcreditforfree.com, we'll do it for free for you. If you need a quick 100-point boost, anybody that's under 800 credit score. If you're over 800, this is not the right program for you, but if you're under 800, let us fix your credit for free. I think the only requirement, you have to donate $150 to our legal program. We sue the credit bureaus constantly. So if you Google us, you'll see that currently we have 3 major lawsuits against the credit bureaus. Our job is to try to keep those guys playing fairly, which they never do.
Gotcha. Very powerful. So one more time, can you give us your website and also then the Perfect Credit website again?
Okay, so our website is perfectcredit4free.com. And let me give you our 800 number. If you want to call our office, if you have more questions, it's 888-551-5533. 888-551-5533.
Very cool. And I'll put that information in the show notes as well. And so it's easy for them to find you and remember. So good stuff. One last question for you. My audience is comprised of educators of all levels, and we're at the time of the year where brand new teachers are getting ready to go in the classrooms. And if you had a chance to talk with an audience of all these brand new teachers,
yes,
what's something you would want to tell them about this?
Are you sure you want me to answer this one? Because I love this question. Cool. You don't know how much. Because let me tell you this, I am angry with educators. I want to show something to you. If you Google colleges, universities, high schools that offer a class on credit restoration, guess how many you will find?
Ooh, I'm afraid to guess at that one.
0.
Wow.
I've never seen a college, university. And however, if you talk to a professor or teacher after a student graduates, what is the most important financial things that they will have to deal with as a young adult? It is always credit. Credit controls where they live, where they work, how much money they have in the bank. Will they be able to start a business? All those things are controlled by credit. So I'm really trying to push educators, please offer credit classes. There's no reason we don't. Financial literacy is a problem in America. So we need you. The older educators probably they're so used to not having it, they don't think about it. You new teachers, new educators, you are the future of America. To put us on a competitive playing field, we need credit courses. If you have any concerns, I wrote a credit course, Credit 101, which I will give you for free. I'll give your school, your institute for free. Just teach the kids, teach them.
Very cool. Love it. I love it. Dr. Grayson, thank you so much for talking with us about, smart consumer spending, outside impacts on what we spend, and your company, CDMI. Awesome information, much needed. Much needed about those credit scores, man. And wishing you the best in all that you do.
All right. I really appreciate you, man. Keep up the good work. Thank you for having me.
Hey, you have been listening to Teaching, Learning, Leading K-12, a podcast to help you help kids achieve their dreams. Teaching, Learning, Leading K-12 is a member of the Education Podcast Network. Podcasts for educators, podcasts by educators. Teaching, Learning, Leading K-12 is a member of the podcast network based in Canada called Voice Ed Radio. Voice Ed Radio, your voice is right here. The opinions expressed on Teaching, Learning, Leading K-12 are those of the guests and host. Teaching, Learning, Leading K-12 is intended to share ideas, advice, and suggestions. Teaching, Learning, Leading K-12 is produced for educational purposes. Hey, thanks for listening. It would be awesome if you visited my website at stephenmiletto.com and connected with me, left a review, and listened to more episodes. And by the way, you could also share it with your friends, with your family, and your colleagues. Thanks so much. You're awesome.